Hello and welcome to Portfolio Matters Weekly Update Week 28. We have a lot to discuss this week and we will mainly be concentrating on inflation. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Keith, what have we got this week?
Thank you, Richard. Well, this week we have a lot of updates on inflation. So, going through the numbers we received this week, we had US CPI, which came in at 5.4%, up from 5% in May and well ahead of expectations. And core US CPI came in at 4.5%, up strongly from 3.8% in May and again above expectations. US producer price inflation, that is the output price from US factories, came in at 7.3%, again up from May and beating expectations. So the general picture is of inflation which is much higher than the Fed's target of 2% and is rising and is beating expectations. We're moving on to other economic data from the US. US industrial production came in at 9.8% year on year. Now, bear in mind, there are base effects. So the question is, how did June industrial production compare to expectations? And expectations were for 12.2%. So that's undershooting expectations. Manufacturing production also rose by 9.8%, and that again missed expectations, but though not by very much. In the EU, industrial production rose by 20.5% in May, which was below expectations, which was 25%. In the UK, we had inflation numbers and CPI came out at 2.5%, so substantially lower than the US, but still above May's figure and above expectations. And core CPI came at 2.3%, again, rising from May and above expectations. In the UK, we had both producer price inflation, input prices and output prices. Now, input prices rose by 9.9% year on year, and that undershot expectations, which is good. But output prices rose only 4.3%. And that is actually quite reassuring because that undershot expectations as well. But the combination of the two of them, very high input prices and lower output prices, suggests that margins should be squeezed.
It also suggests that, let's say it takes a month or so for inputs to turn up as outputs in terms of the sort of product, the inventory manufacturing. Therefore, it suggests that output PPI next month or 2 months' time will start to reflect the input PPI.
Very good point, Richard. Yes, absolutely. Now, when we talk about inflation, you can have transitory effects caused by energy prices or shortages, but what really matters about ongoing inflation is wages. If wages start to rise, then inflation becomes embedded in the system. And this month we had wage figures for May from the UK, and they are not reassuring. So UK average weekly earnings, including bonuses, rose by an annualized 7.3% in May, which is well up on April and beat expectations. Excluding bonuses, it came in at 6.6%, again, well up on April and ahead of expectations. And that is a sign that inflation expectations are becoming embedded and people are demanding higher wages. The UK unemployment rate, however, ticked up, but that is misleading currently because of the low labour participation rate, and there's a question of where more people coming back and looking for work. In China has been slowing down, but we got some slightly reassuring numbers this week, in that industrial production rose by 8.3% year on year in June, which beat expectations, although it was slightly down on May. And retail sales came in strong, up 12.1% annualized, and that beat expectations. So going through a few charts, well, one of the things we haven't touched on actually, but is news, is that China has cut the required reserve ratio, which is the amount of reserves the banks need to keep to back their loans. And the lower the RRR, the more loans they can put into the system. And so the Chinese government is becoming concerned about the fall in consumer credit and are cutting the reserve ratio. And that may well have an effect. But the flip side of that is that encourages yet more debt in a Chinese system that is very heavily indebted. Okay, so this is the US inflation rate, and you can see it is soaring. And this is core, and core, frankly, this is frightening chart. So that excludes food and energy. Producer price inflation, again, rising strongly. I mean, in all these charts, this is the strongest inflation we have seen in a long time. This is the UK. Now, the UK and Europe are lagging. European inflation numbers are due to come out around 10 a.m. today, and we haven't got them yet. But essentially, UK and Europe have locked down for longer and have been slower in taking the lockdowns off. So we are seeing inflation coming through more slowly in the UK and Europe. This is UK core CPI, and again, rising strongly. And this is earnings. Earnings look strong, and that means more spending, more demand. Future inflation begins to be baked in. Okay, so what we're going to do this week is we're going to mainly concentrate on inflation, and I have prepared a pack of charts that I would like to talk through, and then Richard will separately talk through the charts that he has also identified this week. So this is US CPI, as we have discussed, and the shape of this chart is really quite frightening. And in previous weeks, we have talked about how the rise in US inflation has been caused by a few outliers, by strong rises in car rentals and used car prices. And actually, if you look at the median components of US CPI, then inflation has actually been not too bad. Well, inflation is now picking up if you trim out the outliers. So you're seeing a broad range of prices rising in the US. However, remember that last year was an extraordinary year, that there was deflation in some components of CPI last year, and therefore there are base effects. And if you strip out those base effects, it's not quite as frightening, though it is still well above Fed target.
I also think the stripping out base effects is ripe for manipulation, Keith, because it gets to be really, you take a complicated calculation and then you complicate it with another layer of complication.
That's very true.
I suspect that this is possibly, not necessarily rigorously created. I think we've had this issue before with base effects.
I would also add, Richard, that as various commentators have pointed out, the whole of the 1970s, economists were saying that inflation was transitory, and there were various always coming up with reasons why it was transitory.
There's a new term now, Keith, isn't there, which is permanently transient inflation.
Yes. But when we break down recent inflation, it is true, a lot of it has come from a few pandemic affected areas. So the biggest component has been vehicles, new and used cars, and also by pandemic affected services like airlines, hotels, and pubs, etc., where essentially they've got vastly increased costs and they have reduced clientele and they've been raising prices. And if we think about cars, the reason that we have such a sharp spike in the price of both new and used cars is because demand has been constrained. So what happened was last year, all the car manufacturers saw a fall in demand and they cut back on their supplies of chips. And so the chip manufacturers then cut their production, and now there's a huge shortage, but that is now easing. So that should be transient. However,
just chip in there, Keith. I think one of the issues that we have is that whilst the used car price inflation will stop, and obviously it's going to stop at some point. The question is, do prices stay at that level? Do they slowly fall back? That's one question. The other question is that inflation feeds through into costs experienced elsewhere in the economy. So there's a sort of simplistic argument being used in some parts of the media, which is that if a single factor is transient, then it doesn't affect long-term inflation. But that's spurious, because that increased cost goes into the cost of production of food, production of goods and services, and it does stick. So I think we need to be careful about following the mantra that transient doesn't matter, and that temporary is irrelevant. Like you said in the 70s, everything is always temporary, but the combined effect is not a sort of a single factor effect.
Yeah, I mean, I would hope that rising productions, but the factories get back to normal output, the prices should fall, particularly those of used prices, and we should see prices coming back down. But I take your point, Richard, and we just have to watch it. Yeah. But while we are on cars, I would like to just raise a general point that we're doing this transition to electric vehicles, which currently are about twice the price of internal combustion engine cars. Now, how are they going to treat that in the CPI numbers? Because actually, if you mandate everyone having to replace their car with a different vehicle, which is twice the price, do you account for that in inflation?
They'll make a hedonic adjustment, Keith, by saying that the utility of an electric car is twice that of an internal combustion engine car, and therefore the effective price is half, and therefore there's no inflation effect.
I think you're right, Richard, but I think the mechanism will be slightly different. I'd say there are two different categories. I think they will adjust the price of internal combustion engine vehicles and all separately those of electric vehicles. And when you switch from one to another, they will say that is a choice and that has not affected your inflation.
Yes. One way or the other, they won't let it go in the data.
Absolutely. Okay, so returning to inflation. Now, so we're saying that car price inflation is likely to have been transient and will fall. However, it is just about to be replaced as a transient input to high inflation by a surge in rental prices, property rental prices in the US. And you can see here that apartment rents are shooting up, and that is soon going to appear in the CPI numbers, and that is being driven by a surge in apartment occupancy to all-time highs in the US. And as a result of all this inflation, small business surveys are reporting that the number of small businesses raising prices is the highest it has been since the late 70s. And all this is evidence of inflation becoming baked in. And the labour market remains tight, so employers should start bidding up for labour if they require it, and that is again inflationary. But currently, what's interesting is that firms are not planning to raise wages. So the brown line is planning to raise wages, and the blue line is the ones planning to raise prices. So currently, businesses are trying to pass on prices without raising wages. And that is a fallacy of composition, because that cuts demand. Inflation goes up, but people don't have the money to spend. And what should happen is that wages will now rise. And you see here that wage inflation is currently actually within the normal range, but it tends to follow the quit rate. Essentially, as employees become more confident that they can resign and get a better job, then employers find they have to raise wages to retain them.
Yeah.
And although wage rates remain in the normal range currently, this was in the FT this week. BlackRock have just raised global wages by 8%. And one thing we know from previous pandemics is that in the aftermath of pandemics, wages tend to rise as the labor becomes scarce. And that seems to be exactly what is happening, frankly. Labor is scarce, and so businesses are going to have to bid up for it. And that raises inflation. And you'll notice this week, as all the inflation numbers came in hot, how the Fed was saying, well, we're well aware of this and we're worried about it, and we may start to do something about it. And the UK was saying exactly the same. But when you look at central bank policy compared to what it should be, and the Taylor rule tells you where interest rates should be to hit the 2% target, you'll see that actually the policy is incredibly easy. The spread between the Fed funds rate and Taylor rule is basically 5% below where it should be.
Well, imagine if they put interest rates up to 5%, Keith.
Yes.
What would be the consequences of that?
Yes. So essentially they're letting everything run hot. Right. Richard, your go.
Thank you, Keith. So this is velocity of US broad money. We don't know what FOF means, actually. We looked it up. We couldn't find it. But the velocity of broad money in the US has plummeted in 2020 and is showing no signs of rising back up. Now, what the central bankers basically say is, and many economists say, is that if the velocity of broad money does not go up, you can't have inflation. And I think what might be happening here is that the economy and the way money is counted as a source, the existence of vast quantities of gearing, the shadow banking system, the existence of huge quantities of derivatives. I suspect one of the things that might be happening here is that the measurement of broad money is becoming increasingly difficult. And we don't really know whether velocity of money is dropping or whether its money is going somewhere else. And we don't really know whether this velocity is accurate. The other thing is that the calculation of velocity of money is a derivative. It is the number that drops out of the equation PV equals, Keith, correct me, come in?
PQ equals MV, mate.
Thank you. PQ equals MV. And the one thing you can't measure in that at all is V. So it is the product of PQ over M.
Yes.
So I'm just going to be slightly existential here for a moment. And I'm going to just want to talk about complex systems. And we know the US, we know the world economy is a complex system. And I just had what is a complex system? Well, I thought 4 or 6 billion years ago, however many years ago the solar system was a ball of intergalactic dust. Had an external observer been looking at that ball of intergalactic dust, could they have predicted the Euro 2020 final at Wembley between England and Italy? And of course they couldn't. And that is the definition of a complex system. We have central bankers and economists allied to central bankers and politicians saying they can predict the economy perfectly. And my response to that is, no, they can't. Nobody understands how this all works. Nobody understands what the consequences are. All you can do is make an informed guess. So I'd just like all of my comments to be seen in that context, really.
Yeah.
Keith, next slide, please.
The other thing I'd say is that economists have an absolutely awful record of predicting anything.
Yes.
As do I, actually. Anyway.
Yeah, likewise. So the Bank of America has produced 2 meters, transitory and persistent inflation meters, where 100 equals historically high inflation. And basically, the Bank of America transitory inflation meter is at 100. And now the persistent inflation meter is at 75. I just thought that was interesting to see their perspective on what inflation might be doing. So this is a chart of which we talk about from time to time, 40-foot shipping container prices from China to America or China to Rotterdam. And there is no sign that these prices are tailing off yet.
Yeah. So
this is a quote that I got. Unfortunately, I haven't attributed it. But if we still calculated the CPI the way we did in the 1970s, inflation would be apparently already double-digit and as high now as it was then. And of course, Shadow Stats is very keen on alternative inflation measures, and their alternative inflation measure is is probably over 10% now. I haven't looked at it recently.
Yeah. Now, I'm well aware of the change from RPI to CPI, where they, instead of taking the arithmetic mean, they take the geometric mean, and they assume that means because, carrots are expensive, you're switching into broccoli. But, if you look at just the price of carrots alone, it's gone up a lot. And assuming there's a substitution, making this philosophical adjustment about the basket of the cost of living as opposed to the actual changes in prices.
I think the problem we have is that if you have real GDP, so a nominal GDP growth of 3% and inflation is 2%, then you've got real GDP growth of 1%. But if inflation is 4%, you're in a recession.
Yeah.
And I think that inflation is being manipulated because if it were calculated correctly and publicized correctly, we would be in and out of recessions all the time. And we would probably be in a recession now, other than the fact we've got this huge issue with GDP coming out of the pandemic. And I think there is an incentive for central banks to continually understate inflation so that real GDP appears to be going up when it isn't.
Right, let me push back on that, Richard, and be devil's advocate, because I would say there's also a counter-argument that inflation is massively understated, and that actually, if you think about the modern living standards compared to, let's say, that of King Henry VIII, that the average person in this country has a better living standard than Henry VIII did. We don't lose our children to childhood diseases. We have much better health, etc., etc. And when new technology comes in, it comes in essentially as at 100, and you then adjust its price down from there. You do not adjust for the fact there is the new technology, like switching from horses to cars or from petrol vehicles into electric vehicles, etc. So, it is at heart a philosophical discussion, amongst other things.
That's a very, very interesting point, Keith. Yeah, I agree with that. So Keith has talked about this one. US core consumer prices rise at fastest pace in 30 years. Intermediate materials, less food and energy. It's rising at a 5-month rate of change of 12%,
Wow.
which is extraordinary, eye-watering, and higher than it was at the end of the 1970s. Raw PPI continues to accelerate. We've covered that.
Yes, but I asked you to keep this in, Richard, because frankly, I look at this and it just looks incredibly painful.
Yes. So Keith referred to this in the sense that companies are experiencing price increases. They are trying to push out price increases and their margins are being squeezed, and they don't want to raise pay. They don't want to raise pay because that squeezes their margins even more, and then they have to raise their prices. The problem here is that they are facing a collapse in margins with rising input prices, and they are going to have to raise prices if they want to maintain margins. And they're going to be under increasing pressure to raise wages. And there is a danger that we are starting to enter the wage price spiral that Keith referred to. And I think that is underestimated generally, that we may be entering that phase of inflation.
I'd also say that earnings expectations are very high. So having discussed inflation for a while, what is really striking is how the bond market is absolutely convinced that inflation will be transitory, and yields have actually come down, even at the long end, well, particularly the long end. So investors have been reassured by the Fed's calming words and have continued to buy treasuries. And junk bond yields are currently negative, real junk bond yields. So, bond investors just seem extraordinarily complacent to me. And the danger is that one day they all wake up and realize they're wrong.
I would comment here that commentators say that the bond market can see through transitory inflation, knows what's going to happen, and you look at this and you think, surely the bond market doesn't know what it's doing.
Yeah.
And I think that the reliance of some parties on the bond market as an indicator of where inflation is going is spurious. Now, I'm not saying inflation is definitely going to go up, and I'm saying that using the bond market as an indicator is not sensible, because there are so many factors that influence it apart from sensible purchases because of the quantitative easing around the world.
Well, I'm concerned that if inflation remains high, then at some stage this transitory narrative changes. And it could change very quickly, given how extreme positioning is in things such as junk bonds, where the real yield is negative.
Yes.
And then that creates volatility and causes problems for all financial assets.
Yeah.
Right, moving on to the checklist. Well, it was a poor week. And when we go onto my personal portfolio, you'll see I had a really bad week, actually, as oil came off. So the oil share was down 1%. I have added this week the Stocks Europe 600, which is a pan-European index, which includes the UK. And that was only down 0.2% this week. The S&P 500 was down 0.2%. The NASDAQ was down 1%. Topics, the Japanese index was up 1%. Bitcoin continued to drift off, down 6%. And sterling was stable, up 0.2%. Okay, now the next few charts show the impact of QE on equity returns. Now, this chart requires some interpretation. So what this chart shows is the distribution of daily returns in the S&P 500. So this number 13 on the right, where my cursor is, that is a daily return of over 13%. And that happens not very often. This is frequency. And so you see changes of between 0 and 0.5% are very frequent. And what this shows, the blue chart is days when there's QE. The white chart bars are when there's no QE. And what it shows is on the days there are QE, the blue bars are shifted to the right. There are more blue bars far right and none far left. So QE shifts the entire distribution more positively. And QE tapering reduces that effect, and quantitative tightening shifts it further. So under quantitative tightening, returns of the S&P 500 are lower. And quantitative tightening is coming up.
This is interesting, Keith. I was doing a little bit of research into QE this week, as I do from time to time, because I still don't understand it. And I came across various explanations of how it works that I think are wrong, some of which I think are partial. And then I came across one that said, we don't understand how QE works, but it seems to. And I suspect that is the most accurate interpretation of what's going on.
Yeah. But anyway, we are due tapering and then tightening. So, you might expect the extraordinary run in the US in particular to start faltering.
I would just comment that if they do tighten, interest rates will go up. And if interest rates go up when people are concerned about inflation, there is a danger that interest rates will spike rapidly and the Fed will have to step in to control that and either do more QE, stop tightening, or yield curve control, which is a form of QE. And basically the consequences become very difficult to see because there are so many moving parts in this picture.
I agree with that, Richard, and I wouldn't really attempt it right now. I think we have to see what happens, because I would previously have predicted that rising inflation would lead to rising bond yields, and that ain't happening.
No.
So we just have to see how things develop. Now, this is another really interesting chart, which again requires a bit of interpretation. And what it shows is the relationship between allocations to equities and 10-year future returns. So the orange line shows the allocation by investors to equities, and currently it is well above the 70-year average. And the blue line has the axis on the right and shows, and it's an inverted axis, shows the return over the subsequent 10 years. And what you see is low allocation to equities is associated with high future returns and vice versa. So when allocations to equities are very high, as they were just during the dot-com bubble, future 10-year returns are very poor. In fact, they were negative. And we currently have high allocations to equities. So the expected future returns of the US stock market are poor. They would be negative.
Interesting chart.
Richard.
So cryptocurrencies, Bitcoin. This graph shows that Bitcoin is now making a series of lower highs and lower lows, i.e. a downtrend, having dropped significantly in April and May. There are people talking about whether this is a head and shoulders, including myself. I mean, it is a head and shoulders pattern. And the next chart is my chart with the head and shoulder, with the base of where the base of the head and shoulders would be, and it hasn't yet dropped through that line. Whether it does remains to be seen, obviously. But all the moving averages are now moving downwards. So the question then, if you go to the next chart, Keith, please. So Ether, which shows actually a more clearer head and shoulders pattern. It's got a double shoulder on the right-hand side. But again, it's just about at that line, which a classic chartist would say if it breaks through that, then you've got a head and shoulders retracement down to a pretty low point. Now, I think the next chart, Keith, I've put Ether on a log chart. Now, previous viewers will remember that we've discussed whether we have this sort of exponential growth in the uptake and utilization of particularly Bitcoin and Ethereum, and that it's more sensible to plot the pricing on a log chart, which is what I've done here. And if you put in a trend line, which I've tried to do on the log chart, you can see that there is still a head and shoulders there, in fact, which is quite interesting. And the pricing is around about the line that you would draw through to demonstrate the head and shoulder. And if you then sort of try and work out where the trend line and the price line would meet, you have to sort of interpolate it a bit. You might find that the price line meets at maybe 1700, something like that. 1700. So whichever way you cut this at the moment, the price charts of these cryptocurrencies are not looking good. And then the final chart is the Shitperp chart, and that is looking probably even sicker. But again, it is just where you might well be inclined to draw the head and shoulders line. So I think the jury's out. I think that there's no need to buy cryptocurrencies at the moment. That if you want to make a speculative investment, in inverted commas, in them, now is not the time. Bide your time and see what happens over the next few weeks, possibly over the summer.
Well, I think you've played these cryptocurrencies very well, Richard. You will, I suspect, when this is all over, and I expect it to be, you'll be one of the few people who've made money out of it.
Oh, well, we'll see, Keith. Thank you.
And this is the Fear and Greed Index from CNN. And after this week's small sell-off, actually, the fear is rising.
Or the greed is falling.
Yeah. Now, while we talk about equities, I saw this on one of the chat rooms, and equities are dangerous. And this is a posting from somebody called Mr. Patience. And I had a look through his previous posts, and there are infrequent, and there's one from the 6th of January where he says that he bought in at 32p, but 100 grand in this company called Bidstack, which does in-game advertising. And unfortunately, you can see what happened next. So he's then saying, my life savings, 130 grand, have almost evaporated. His daughter's savings of 40 grand almost evaporated. 78-year-old mother's life savings of 80 grand plus almost evaporated. Yeah. Don't put all your eggs in one basket. Or if you do, be nimble and get out at the first sign of trouble.
This is why, Keith, you have to have a mental point at which you exit a position, whether it's a 25% loss or 20% loss. You have to have a point at which you don't take any more losses, because whilst you may miss out on a gain in the future, what you will certainly avoid is being wiped out.
Yes, absolutely.
It's really important not to let your losses run and to think that you know better.
Absolutely.
I'm tending towards something I mentioned the other day. I'm tending towards basically going more on news and only investing after there's been good news.
Yes, I think that is actually, I'm sort of coming around to your view as well, Richard, but I would urge everyone who has not yet seen it to watch our My Worst Trade with Lee this week, where we also talk about these issues. And I will be doing a My Worst Trade next week. Okay, moving on to the weekly checklist for commodities. And commodities, by and large, completely ignored the sell-off in equity markets, the volatility there, and continued rising. So aluminium was up 1%, cobalt was up 4%, copper was down 1%, but remains close to highs. Chromium was flat, at highs. Iron ore continued its astonishing run, up further 1.6%. Lithium was flat. Neodymium continued its bounce back, was up 7.3%. Nickel was flat, up 0.1%. Ferrovanadium came off from recent highs, down 2.5%. The only big faller was crude. And two things happened in crude. The markets continue to be worried about the lack of an OPEC agreement, and there are lots of rumors that the UAE and Saudi have come to an agreement, but there's been no announcement yet. And also, the US inventories actually showed a small build this week when everyone was expecting continued draws. Coal up 6.1%. Absolutely astonishing performance from coal, and uranium was flat. So quickly talking about oil consumption in the US, and what these 6 charts all show is the relative consumption of different types of crude oil products relative to recent history. So in all these charts, the dark yellow line is this year, and the dotted lines are previous years. And you will see that in the vast majority of cases, consumption is back to normal or above previous years. The only one that's really lagging is jet fuel. So most of the economy is back. Jet fuel is lagging. But then when we look at the passengers going through US airports, what this chart shows, it's rapidly rising back to normal. We're going through some charts. So this week I have all these charts are the 25-year view. And aluminium, very strong, but actually last couple of weeks it seems to have topped out a bit, but at very high levels. Cobalt has, after a sell-off, has resumed its run up and is back to its previous near-time peak, which is bullish. Copper is off a very high recent near-term peak and has stabilized. Richard.
Thank you, Keith. So this is an interesting chart. Copper ore grades mined in the US, and you can see that in around about 1900, the typical ore grade was about 2.5%. The typical ore grade now is about 0.4%, and it's followed this sort of exponential line all the way down. And what part of the point of this chart is it's saying that the good quality resources have been found and have been mined. So it is now more expensive and harder to find good quality copper resources. And then the next chart, let's see, a couple of quotes from the Financial Times. So global mining and smelting capital expenditure peaked at 220 billion in 2012. It was only half that level last year, according to Wood Mackenzie. Exploration spending has also dropped from 35 billion in 2012 to 10 billion last year. And separately, Goldman sees an annual supply shortage of 8.2 million tonnes emerging by 2030. To put that figure in perspective, last year global refined copper production was 23 million tonnes. So effectively a 30% shortfall on current production in what is about 8 years' time. And combine that with the difficulty of finding high quality resources, the political uncertainty that we've now got in Peru and Chile, which are significant producers of copper, the outlook for the copper price is looking very strong, I think.
Yes. Okay, so crude, well, it had a poor week, but, on the
scale of things,
yeah, not much really. It's still price compared to where it was last year. Coal, look at coal. I mean, the thing is, we need energy and we're cutting the coal supply. And in the short term, renewables are not filling the gap fast enough, and the coal price is going through the roof. Iron ore, I mean, I've got this so wrong frankly. I did not think the iron ore could stay this high for this long, because half the planet is half iron. We don't have a structural deficit in it, but the Chinese have stopped buying Australian iron ore, amongst other things, and the price of iron ore is going through the roof. Neodymium had a bounce. Nickel is rising.
In a nice uptrend, actually, isn't it? And it's a 7-year high now.
Yeah. Now, as we've discussed on previous weeklies, the commentary I've read is that nickel is in structural oversupply for the next few years, but the nickel market doesn't seem to know that.
Goes into deficit in 2025, I think, is the current projection.
Yeah. But the price is rising right now. So ferrovanadium has had a good run, but is now coming off. Moving on to precious metals, all of which had a good week on the back of the fall in yields and the rise in inflation. So gold is up 0.8%, silver up 0.4%, platinum was up 2.5%, rhodium had a bounce. So it has had a sharp sell-off, and then this week it bounced by 12%. Really, the volatility in rhodium has been astonishing. The only faller was palladium, which tends to be a substitute for rhodium. So as rhodium bounced, palladium sold off. So this is the gold chart. And Richard.
Thanks, Keith. So this is my response to some dodgy gold charts, which, as you know, we like to discuss from time to time. So the dodgy gold chart in question is the one that says if you'd invested in gold, you've done better than the S&P, which is true if you'd invested in the top left chart in around about 2001. And you'd have done remarkably better than the S&P had you invested at that point. If you'd invested in 2007, you would have done about the same as the S&P. Had you invested in 2009, just after the GFC, you would have done very significantly worse than the S&P. And had you invested in 2015, you would have done worse than the S&P. So this is very much one of those path-dependent investments. If you buy and hold gold for many, many years, you probably will outperform the S&P, as you did in 2000. But you have to be very careful that you don't misinterpret these things and say gold is always going to outperform the stock market, because it is very, very time dependent. And I wanted to show that because sometimes you see this chart which shows gold outperforming the S&P, and it is not as simple as that.
Yes, and the other thing I'd say, Richard, is everyone claims they're a long-term investor until they start losing money, and then suddenly they become quite short-term. So the ability of people to hold gold and watch the S&P outperform them for 7 years in a row is, I don't think anyone can do that.
And in fact, between 2011 and 2016, in gold, you would have had to have endured a 50% drawdown.
Yeah. So silver is doing okay. Platinum has bounced back from its recent sell-off, and in the grand scheme of things, actually looks quite cheap. Rhodium, on the other hand, has had an absolutely extraordinary year and has bounced back, but during this sell-off, there have been a number of big bounces. So is this the end of that the sell-off? I just don't know. Palladium has had a great run and came off a bit. Okay, so finally onto rates. And what you notice is the UK 5-year, the rate rose, yield rose. So that is evidence that investors are expecting the Bank of England to have moved forward rate rises, but at the long end, rates actually fell. So they are absolutely buying into the fact that inflation is transitory and the Bank of England is committed to keeping rates well under control. So this is 30-year, and you'll see it now appears to repeat. So people are willing to buy UK debt at a guaranteed yield of 1.14% for 30 years. Astonishing. And this is the US 10-year. Again, well down from recent peaks. Now, moving on to our favorite chart, the seasonality chart, which, I think has had a pretty good week, actually, because it was been a bit rubbish, certainly for me. And this is actually my new chart, which is the UK, which shows actually July, you do have a couple of sharp sell-offs. Anyway, Richard wanted to talk about this.
So thank you, Keith. These are the last. Keith and I discussed where to put these, and we didn't really know. So regular viewers will recognise this chart and the next one. Small business open in the United States, and this chart now shows the number of small businesses open in the United States is lower than it was at the worst point in the COVID cycle, which is quite extraordinary and flies in the face of all the other data that we've been looking at in terms of economic growth. And the next chart, Keith, is small business revenue. Now, there is a massive inconsistency here, which we frankly don't understand.
No, this is very worrying, actually. And it looks like COVID has inflicted much more damage on US small businesses than is generally believed. Yes. And this means that actually the recovery could be slower going forward.
Yeah. Now, other data suggests, and pundits and central banks suggest that that's not the case. But I think what this is doing is this is a warning flag to say, be aware that things under the surface may not be as they appear.
Absolutely. Okay, Richard, do you want to go through your activity?
Thank you, Keith. So I have had a series of poor weeks, lasting 6 weeks now. It's quite depressing, where I've gone from an optimistic high of 12.4% gain in the year to a pessimistic low of 5.9% gain for the year. What I would comment is I'm quite heavily invested in commodity shares, and although commodities haven't pulled off very much, the price of the miners has have pulled back quite significantly for reasons that I don't really understand. So I'm just sitting pat, doing nothing, working hard to do nothing, because I have confidence in my choices. We shall see. And the only chart I wanted to look at today is that of Ferroalloy Resources, which produces low-cost vanadium in Kazakhstan, had good news regarding funding and regarding production levels, and which basically has reacted somewhat negatively to that news. Now, I think this is probably par for the course with small natural resource companies listed in the UK at the moment. They all seem to be behaving in quite a similar manner. So, as I say, I think we're going through a phase that hopefully we will come out of. And that's my weekly update, Keith.
Thank you, Richard. My new policy, I like ferroalloy, but I'm not going to buy it until it turns around and starts an uptrend. One of the lessons I've learned recently is limit orders, buying more as it goes down is a fool's game.
I think that's very sensible, Keith, and that coincides with the view that buy on good news, and yes. Hopefully, yeah. So, what's your weekly update, Keith?
So, I had an absolutely terrible week. I'm afraid. My performance was down 3.8%. As regular viewers will know, I'm very heavily exposed to oil. And essentially what's happened is the oil price has gone up and all the oil companies have gone precisely nowhere. And then the oil price has sold off and they've all fallen heavily. So there you go. And that puts me up only 2% year to date. And I am massively underperforming absolutely everyone. Richard, Stuart, and the all share.
What happened with Excelsior, Keith? Do you know?
Okay, so, what happened? I sold half my Excelsior this week. And essentially, well, the reason I sold it was as we were recording the My Worst Trade with Lee, I was thinking, I really should get better at cutting positions which are just going against me and where I think, I'm right and the market thinks I'm wrong. So I decided to halve it. Now, what's happened with Excelsior is that there hasn't been much news, but all the news is that the problems with the calcite, which is producing lots of carbon dioxide and is making an acid injection into the rock, those problems just seem quite intractable. Right. And one of the reasons that I sold is that in our original analysis, the one thing I hadn't thought of was water. And in order to get rid of the carbon dioxide, they need water to dissolve it. And they're in Nevada, very dry. Where are they going to get the water from? So I'm still remain hopeful that they will sort this out because it is an enormous resource. However, I think it's prudent to realize that in the short term, I've been wrong. So I've taken half of it off.
Well done.
And the money I took out of Excelsior, I put into RS Strategic, which has been drifting up. And this is my new policy: buy the winners. And I also bought some Petrometad, and we'll go into that in a second.
That would be a buy a loser, wouldn't it, Keith?
Well, yeah, but it's
a funding down.
Yeah, it's a technical funding issue, which is very annoying. Anyway, so this is the sorry tale of my portfolio. So you'll see, this is the relative PE ratio of European equity energy stocks. And as their earnings have gone up, the market has actually been marking them down. So their PE discount to the rest of the market has absolutely collapsed. They're much, much cheaper than the rest of the market. Now, I'm expecting that to close. Time will tell whether I'm wrong or not. Yeah. Okay, so this is Excelsior, and frankly, this is the story of my life at the moment. Everything I touch turns to lead. So I bought it averaging in about here. It promptly sold off. And I sold some here, and it promptly bounced. There you go. Luckily, it's only a small position. Now, we had lots of updates this week, one of which was in Capital Drilling, now called Capital Limited. And you will remember that we like the shares because the shares are good value and it has been growing rapidly. So we bought, recommended back here, and it's now up a third. And the revenue numbers were great, frankly. So quarter on quarter revenue growth, up 24%, up 68% last year, and the shares rose, but actually not very much. And the shares, so you're getting this enormous revenue growth on a forward P ratio of 9.9.
Well done, Keith.
Right, now, Petrometad, which I am frankly annoyed about. So your regular viewers will know that they got the exploitation license for the Heron well. And then when we talked about it last week, we were concerned about how they're going to get funding for the production well, bringing the field online. And the answer was, what they were going to do was do a massive discounted share placing to institutions at 3.5p, which is a huge discount to the share price when which is a huge discount to the share price when the exploitation license was announced. And it rode over preemption rights from investors. Now, I take this very badly because I think, A, it was unnecessary. I think shareholders would have been supportive for actually what is quite a small amount of money. It's only $10 million, but it also shows how difficult it is for small oil companies to raise funding at the moment. And going forward, I think funding is a huge issue for all these small commodity companies, particularly oil companies. And if an oil company needs funding, watch out and do not touch it until the funding has been resolved. So the share price is now actually 3.25p. So it's below the offer price. And so the placing to retail investors at 3.5p is not going to work. Retail investors will not buy shares at a premium. And it just shows that Petrometad have severely dented the confidence of private investors, because actually it's good news. They have sorted out the financing, but they have completely messed up the share price and lost a lot of money, hopefully temporarily, for shareholders. Okay, so a couple of our copper companies had drilling results. Castillo Copper have announced that they have their drilling campaign in the big one looks successful, but we are awaiting assay results. And in the short term, the share price has bounced. Phoenix Copper have been drilling into their mines, and they have found sulfides deep down at the Empire mine. But again, we're awaiting assay results. But those both look positive. And finally, I have a winner. One of my dodgy oil companies, which has big assets in Alaska. So share price is shooting up, and I'm just going to let it run. I'm not going to buy any more, actually. But
well done, Keith. Very good.
Well, it's nice to have one. The rest of the portfolio is terrible. Okay, so I think that's it for this week. Thank you all for watching. Please, can you spread the news and try and get our subscriber base up? In the meantime, please, can you press subscribe and press like? And it is goodbye from Richard Wheater.
And it is goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.